So the first question, what is a tariff? So basically, a tariff is a tax on imported goods to protect the domestic industries or raise government revenue. And then what is a reciprocal tariff? A reciprocal tariff is a matching tax imposed in response to another country's tariff, aiming for fairness or negotiation leverage. So the second question, how will this reciprocal tariff directly affect Taiwan's exports to the United States, and how will it directly affect Taiwan's imports from the United States? So the tariff will reduce Taiwan's exports to the US because Taiwanese goods become more expensive for American buyers. They think our goods will be more expensive because the tariff. And then Taiwan's imports from the US will not be directly affected because Taiwan didn't raise its tariff. We didn't raise our tariff on American goods. Yeah, so the goods from American will not be more expensive or more cheaper to us. And then third question, what is the nominal exchange rate and how will the nominal exchange rate be affected by the tariff? So what is the nominal exchange rate? It is a rate that one currency can be exchanged for another. So for example, it shows how many new Taiwan dollars can get for one US dollar, like maybe 30, 29, or 28. And then this reciprocal tariff reduces US demand for Taiwanese exports and decrease the supply of USD in Taipei's foreign exchange market. So it shifts the supply curve left and raising the nominal exchange rate. So the nominal exchange rate go up. And then based on my graphical analysis, will the new Taiwan dollar appreciate or depreciate? So the answer is it will depreciate because when the nominal exchange rate goes up, it means that we need to use more Taiwanese dollar to get one US dollar. So it means that Taiwan dollar depreciated. And then how will this reciprocal tariff directly affect the United States net exports? So the tariff reduced US imports from Taiwan. However, the exports to Taiwan remain unchanged. So it leads to a net export increasing. And what is the real exchange rate? And how will it be affected by the reciprocal tariff? So the real exchange rate is the relative price of domestic goods in terms of foreign goods and calculated as the equation below. So how will it affect it? As mentioned earlier, because the US is buying fewer Taiwanese exports because it's too expensive. So there is less USD flowing into Taipei's foreign exchange market, which means the supply of USD dropping and it makes Taiwan dollar to depreciate. So because the real exchange rate increases, it makes Taiwanese goods more expensive abroad. And then the next question, based on graphical analysis, will the reciprocal tariff actually improve the United States net exports as Trump expects? Actually, it's no, because when a tariff is implemented, it indeed makes US net exports to go up at first, of course. However, it also causes the US dollar to appreciate. So because the US dollar become more expensive, so Americans are more willing to buy foreign goods, and it increase imports and ends up canceling out the original boost in net exports from the tariff. So the answer is no, it doesn't improve any of the United States net exports.
This is me. I'm gonna talk about questions 2. So first one, in descriptive way, exports increase. So net export will increase. Then aggregate demand will increase. So aggregate demand curve shifts right. You can see from AD to AD prime. And real GDP will increase from Y to Y1. And overall price level will increase from P to P1. In graphical way, we can see in this picture, aggregate demand is AD shift right, and price level and quantity of output will increase in the short run. And the second question is foreign direct investment. So in descriptive way, foreign FDI increase will cause net capital outflow increase. So investment increase and cause aggregate demand increase, and aggregate demand curve will shift right. It's AD to AD prime, and real GDP will increase from P to P1, and overall price level will increase from Y to Y1. In graphical way, we can see AD curve shift right, so price level and quantity of output will increase in the short run. Then the third question, it's foreign portfolio investment. So the second question is no, because it's indirect. And because it's not a factor in aggregate demand, so in the short run, it won't have impact on real GDP and price level. The fourth question is because you take no action, so it will turn out to be in long run, it will turn out long run equilibrium. So the price level increase, then the production cost will increase, and it will cause short-run aggregate supply decrease. So short-run aggregate supply curve will shift left, and in the long run, real GDP unchanged and price level will increase. You can see in this graphic, the short-run aggregate supply curve shift left, so the price level will increase, and quantity of output will back to the original one. The last question. Fiscal policy like gain tax, it will cause consumption decrease, so aggregate demand will decrease, and aggregate demand curve will shift left. And monetary policy like sell bonds, it will cause money supply decrease, so the interest rate will get higher, and it will decrease the goods and services demanded. Then aggregate demand decrease, so aggregate demand curve will shift left. Because aggregate demand curve shift left, so price level and real GDP will decrease.
Okay, so next is the question 3, and this is me. For the first question, when the government cuts its spending, it directly lowers aggregate demands, since government's expenditure are a part of AD. In the short run, this leads to a drop in real GDP and decreases in the overall price level. On the graph, you see this as a leftward shift on the AD curve. Next question. Yes, a multiplier effect is expected. When government spending goes down, it reduces income for business, which then causes households to cut back on their spending. This decline in consumption and investment triggers a chain reaction that worsens the economic downturn, meaning the overall drop in GDP is larger than the initial spending cut. Next. Reducing government spending helps lower the budget deficit, which increases public saving. This boosts the supply of loanable funds, pushing real interest rates down. Lower interest rates tend to encourage more private investment and can also lead to an increase in both private and national saving. Next. As real interest rate falls, more capital tends to flow out of Taiwan in search of better returns abroad. This shows up as a rightward shift in the net capital outflow curve on graph, indicating increased capital moving overseas. And number 5, with more capital flowing out, there's a higher supply of new Taiwan dollars in the foreign exchange market. This causes the real exchange rate to fall. Basically, the NTD depreciates. A weaker entity makes Taiwan export cheaper and more competitive, which help improve the trade balance by increasing net export. On the graph, you see the supply curve shift to the right and the exchange rate drop. For the last question, to sum up, cutting government spending directly reduces aggregate demand, and the multiplier effect makes the lead decline even bigger. On the other hand, the resulting lower interest rate and weaker currency can help stimulate demand through higher investment and export. Still, these indirect effects usually aren't strong enough to completely cancel out the initial negative impact, so aggregate demand is likely to fall overall.